if the digital asset prices stayed exactly where they are today for the next 3 years, what would be our plan? I think that really is the question every board right now has to ask themselves, because that's when you really find out whether you're executing a strategy to build long-term shareholder value or you're just simply hoping that the market comes back and there's not a lot for you to do. Have you ever wondered what's really happening inside the emerging growth markets, or why some companies are able to get public, raise capital, and grow, while others just struggle to get through the process? Welcome to Inside the Emerging Growth Markets. I'm Joseph Lucosky, managing partner of Lucosky Brookman, Wall Street trained, founder focused, and for the last 2 decades, I've advised hundreds of the most ambitious and committed entrepreneurs, investment bankers, and investors across some of the most active and dynamic parts of the capital markets. Whether you're preparing to go public, navigating life as a public company, or operating inside the emerging growth ecosystem, this briefing is for founders, public company leaders, and other capital markets professionals who want to understand how this market actually works today. My goal is simple: to give you a real, clear-time view of what's happening inside the emerging growth markets, and more importantly, what you should be doing about it. In each episode, I'll break down what we're seeing from the trenches, from IPOs to uplistings and direct listings, to reverse mergers, SPACs, secondary offerings, and the ever-evolving regulatory landscape, so you can make better decisions and execute at a higher level. If that sounds good to you, then listen in, because in this market, understanding how it really works can make all the difference.
My name is Caroline, and welcome to Inside the Emerging Growth Markets with Joseph Lucosky. On this show, we take some of the most current and pressing questions on the minds of those of you in the emerging growth and microcap ecosystems and break them down in a live question and answer format for Joe to give you his take from the trenches. So before we get into today's topic, Joe, can you just give us an update on what you're seeing from the front lines of the emerging growth world?
Sure, Caroline. It's been a really exciting time over the last 2 weeks, I think, in the emerging growth market specifically, because there's so many new proposals on the table. And just as an aside, I was able to go down to Washington this past week for my first meeting on the Small Business Capital Formation Advisory Committee, spend some time with the commissioners and the other members of the committee, which was very exciting. And I'll tell you, there's, these 3 big proposals that are before the committee, which really impact the entire emerging growth market. And I think most people are familiar with them, but we really had a good discussion and debate about semi-annual reporting, both for the emerging growth and for larger companies. We talked a lot about registered offering reform and S3 eligibility, basically making it easier for companies to raise money without these rules of $75 million and baby shelf. And then we also talked about simplifying the number of categories for companies: advanced filer, accelerated filer, emerging growth filer, those types of things, and really simplifying them into 2 categories, which would be large accelerated filers and non-accelerated filers, with a little subcategory for smaller companies, which I believe they're going to call small non-accelerated filers. So it was a good week in Washington, got a lot done, and certainly staying on top of these 3 proposals. But the big news out of the market this week is that NASDAQ passed their new $5 million rule, which basically means that if you're an emerging growth company, or really any company, and you trade below $5 million market cap for 30 days, you automatically get delisted without a hearing. That's really the big news this week. It's been blowing up on LinkedIn and other places. As you know, the SEC dropped this proposal back in January. They extended the comment period twice. Well, it finally got passed this week, and it remains to be seen when it will go into effect and how it will be implemented. But I'm sure we'll talk more about that on a future episode. So stay tuned. The good news is lots of reform is coming, hopefully most for the better, but we will obviously keep you posted.
So let's get into some of today's questions. And for those of you that are new to the show, these are real questions coming out of the market right now from companies, boards, investment bankers, and even live deals. So if you've got a question, please send them to us at questions@lucbro.com. That's questions@lucbro.com, and we might cover it on a future episode. So, Joe, today we're going to tackle one of the biggest stories in the emerging growth markets over the past year, which is digital asset treasury companies. Some people think the story is over, and I know some others think it's just entering a new phase. But over the last few months, I've heard you describe some of these companies as becoming mini SPACs, When you first said that, I wasn't entirely sure what you meant. So let's start there.
Well, Caroline, before we get into the mini SPAC discussion, I think we have to really go back to where it all started, because it's easy to look at these companies today and say, well, obviously that was never going to work. But I don't think that's a fair assessment. In fact, it really annoys me when people act like they saw this coming all along, because I can tell you from living in the trenches, that was not the case. And, at the time, a lot of very smart investors and investment bankers and others genuinely believed that they could replicate what Michael Saylor was doing with MicroStrategy. The thinking was actually pretty straightforward, back in 2025. And it really went something like this. If one public company could trade at a significant premium because it accumulated Bitcoin, then maybe other public companies could do the same for, other coins like Solana or Ethereum, or frankly, any other digital asset. So at the time, that really wasn't too crazy. In many cases, it was also actually working.
Okay, so before we get to where we are today, can you just help everyone understand what changed? What happened in 2025?
Well, the crypto markets were incredibly strong coming off the 2024 presidential election, and tons of capital was flowing into that space. At the same time, many smaller NASDAQ companies were struggling to raise capital or dealing with, continued listing issues. So people started realizing something very interesting, and that is that a public company holding a meaningful amount of digital assets or currency could really trade at a premium to the actual value of those assets sitting on the company's balance sheet. And once the market saw that happen a few times, people naturally started asking whether this could be a, repeatable public company strategy.
So was everyone basically trying to become the next MicroStrategy?
For many of them, yes, I think that's exactly how they viewed it, along with tremendous liquidity for many of these companies that they generated, when they announced their Treasury strategy. The thinking about acquisitions or reverse mergers at the time was really non-existent. Nobody was thinking about that. Most of them genuinely believed that they could build the next great, public digital asset company. And honestly, for a while, the market really encouraged that thinking.
So when did your thinking start to change?
Well, it wasn't immediately, I'll tell you that, because remember, we were very active in around 24 of these DAT transactions last year. And honestly, it wasn't until the market started slowing down in, I would say, around November or December of 2025. In fact, I actually gave a keynote presentation in November of last year, and it was one of the investment banking conferences. And I remember telling the audience that I didn't think we were anywhere near the end of this digital asset treasury story. And at that time, I really made two predictions. First, I said that we would have to deal with these legacy businesses being spun out, over time. And we really haven't seen much of that yet, but I thought it was coming. I knew it was coming. I said it would come. But second, I thought a number of these digital asset companies would eventually pivot through acquisitions or reverse mergers into other business lines. Looking back, that's really where the mini SPAC idea started, at least for me, thinking last year. And the more I watched this market tighten and the digital asset prices come down, the more I found myself asking the same question. That really was, what is chapter 2 of this story?
So what were you seeing that made you think the story was changing?
Well, I remember sitting there thinking, okay, what happens if the premium disappears? Because remember, the digital asset prices weakened, and many of those companies started trading closer to, or in a lot of cases, below the value of the cash and digital assets on their balance sheet. And that's when really, everything changed, at least for me.
How so?
Well, remember, simply holding digital assets isn't really an operating strategy. Eventually, the board has to answer the same question that, all boards have to answer, and that is, how do we create shareholder value from here and into the future? And to me, that was really when the beginning of chapter 2 started.
And is that when you came up with the mini SPAC idea?
Yeah, I mean, for the most part, I think that's when it really clicked. I realized I was asking the wrong question along with so many others, because up until then, I was looking at these companies like everyone else saying, hey, they're treasury companies. They have a lot of coin and cash on the balance sheet. Then I started really looking at them as public companies that, happen to have some incredible value contained within them. And many of them, remember, still had a NASDAQ listing that was in good standing. They had meaningful assets on the balance sheet and coin and cash. And I remember thinking, these aren't just treasury stories anymore, right? Especially when the value started to decrease. Some of these companies started really looking like small acquisition vehicles with a lot of cash and coin and assets. And that's really where I came up with the term mini SPAC came from.
That's an interesting comparison because they're obviously not SPACs. So what makes them similar?
Well, before anyone takes that too literally, I guess you're right. I probably should be a little clearer. I'm not saying that these companies are SPACs. I mean, legally, they're completely different. And strategically, though, I think there are some interesting similarities. A traditional SPAC raises capital with the intention of finding a business or finding an operating business to merge with. And, these digital asset companies, many of them already have a public listing. In fact, all of them have a public listing, and many of them still have lots of cash and coin available, very similar to the SPAC model. So you have a publicly listed company with a lot of cash and or coin to go do something with.
And that's why you refer to them like that?
Yeah, for the most part. But also, these companies are now asking a very similar strategic question to the one that, SPACs ask every day. What's the highest and best use of this public company and maybe the highest and best use of our cash, or in the digital asset company case, the digital assets? And that's really what reminded me of the SPAC, not the legal structure or anything like that. It was really the strategic mindset and nature of what must come next for these companies, just like what must come next for a traditional SPAC.
So in your view, this story isn't really ending, it's just changing.
I think so. I think, the Treasury strategy may have been, chapter 1, as we say now. But for a lot of these companies, chapter 2 is going to determine whether they really create long-term shareholder value. And that's the conversation I think the industry and boards need to be having today.
So what changed? Was it the crypto market or was it something else?
Well, I think it was a combination of both. Certainly, the crypto market softened. That's obvious, and that really put a lot of pressure on many of these companies. But actually, I think something really more important happened, and that was that the investors in these deals and the investors in the market became a lot more disciplined. See, early on, investors were willing to assign significant premiums to these deals because many of them believe that these companies could become the next MicroStrategy, just built around a different digital asset. Eventually, though, investors started taking a closer look and asking much tougher questions. And that question really was something like, if I can buy the underlying digital asset directly and now more easily than in maybe times past, why should I own the public company instead? That's a completely different conversation. But that conversation didn't start until the latter part, or maybe the third quarter of 2025.
So if that's the case, how should management teams and boards be thinking about that today?
Well, if I were sitting in that board meeting or on a board, I would probably ask one simple question, and that is this: why should an investor own our stock instead of simply buying the underlying digital asset? If the answer, at least in my mind, is only, well, because we own the coin, then I'm not sure that's enough anymore. That may have been enough in 2025, but it's not enough now. And eventually, the market expects management, and the board to create value beyond, simply accumulating these digital assets. That's when the discussion really begins to change.
What does that exactly change into?
Well, it changes from a mindset of treasury management to a thinking of really capital allocation and investment. Because once the market stops rewarding your treasury story, management really has a different job. And now it's about creating long-term shareholder value. I think a year ago, boards were asking questions like, what digital asset should we own, or how much capital should we deploy, or cash we should keep on the balance sheet? Today, I think, the better boards at least are asking something much more important. And that is, what's the highest and best use of our public company over the next 3 to 5 years? And that's a much harder question to answer.
And are all of these companies going to reach the same conclusion, do you think?
No, I think that's actually the point. There is no one right answer. There are already companies proving that the Treasury strategy can continue to work extremely well.
Could you give us an example of that?
Sure. I mean, I think the one that comes to mind that most people know is, the Bitmine deal. That's probably the best example. They've executed extremely well. They've raised a tremendous amount of capital. I believe, last time I checked, although this could be down a little bit, somewhere around 12 or $13 billion of cash and coin. Now, again, the value may be down now, but at one point they had that. And if they continue executing, they may never need a second chapter. They may just continue to execute and keep Ethereum on the balance sheet forever. But that's not really who I'm talking about. In fact, Bitmine, if they ever decided to acquire another company, they'd probably be the biggest SPAC, or in this case, mini SPAC, my term, the world has ever seen. I mean, there's never been a $13 billion SPAC. So most treasury companies, though, Caroline, unfortunately, aren't in that position.
So it seems that Bitmine is really the only exception.
I think there's a few others too. And sometimes, those companies will stay the course. But listen, if your strategy is working and your shareholders are benefiting, then, you continue to execute. There's no reason to force a change. Now, I will say the Bitmine stock has come down substantially over the last year or so. So they even, also may be thinking about a chapter two, but in a very different way than I think some of these other companies. And remember, I'm not advocating that every treasury company needs a pivot. All I'm saying is that the board needs to start asking the right questions.
And what kind of questions should they be thinking about, Joe?
Well, the way I look at it is this. Imagine your company still has meaningful cash or digital assets on the balance sheet. I mean, even at depressed levels, let's just say you got cash and coin. I mean, you still have your NASDAQ listing. You have access to the best capital markets in the world. I mean, I would ask myself, what's the highest and best use of those assets over the next 3 to 5 years? And maybe the answer is to continue building the treasury, right? That's an acceptable answer. But maybe it's also making an acquisition or executing a pivot, because pivoting into an entirely different industry could create a tremendous amount of value for shareholders, vis-a-vis just holding the crypto on the balance sheet and kind of hoping things turn around and sort of seeing what happens. The bottom line is, though, there's really no one right answer, and every company is different. And I think every board has to ask these questions and come up with their own unique answers.
So is that really where the mini SPAC comparison comes from?
Yes, for the most part. But again, I'm using it as a framework, Caroline, not as a legal definition. A traditional SPAC raises cash first and then starts looking for an operating business. Many of these companies already have something incredibly valuable, like the listing and the cash. Now they're asking a very similar strategic question, right? How do we deploy these assets to create long-term shareholder value? And that's why I use the term mini SPAC, not because of the legal structure, but because of the strategic opportunity that all of these NASDAQ and some New York Stock Exchange company have right now to define their future and see what makes the most sense for shareholders over the next few years.
So some people may hear that and think you're saying every digital asset treasury company is eventually going to become an acquisition vehicle. Is that what you're saying?
No, not at all. Some of the earlier well-capitalized companies, may continue to execute their treasury strategy very successfully, like we talked about, Bitmine. I don't think they're going to be looking for an acquisition now. I don't know. They could, but it seems to me, they're one of the ones, and there's other examples that will sort of stay the course, right? They have enough strength and stability and foundation to kind of see what happens. Others may decide to also remain purely a digital asset company or a treasury company, and maybe they won't do as well. And others will probably pursue acquisitions, pivots, or some type of reverse merger. Every situation is different. The point is that many of these companies now have strategic options that they didn't have before, before 2025 and before the digital asset craze kicked off. Now they have more options.
Would you be able to give us a real example of that?
Sure. I mean, I think a good example is a company called Zone. They started as Clean Core, a public company that's listed on the New York Stock Exchange. I think they had a cleaning solution business, and they completed a Treasury deal last year with Dogecoin, and they did a Treasury transaction, in September of last year.
And then what changed?
Well, the market changed. I mean, the market started to turn in late 2025 into early 2026. And the board started thinking and asking a different question. No longer was the conversation, how do we build a bigger Dogecoin treasury strategy? But it turned to, okay, how do we create long-term shareholder value? How do we um, grab that value for these shareholders over the next few years? And that's a very different conversation the board had to have. And to their credit, they had it. And, I think a few months ago, they announced the strategic pivot.
And what did the board decide to do?
Well, they decided to pivot into a data center space, with acquiring and rolling up some operating companies in that area, and really had to answer the question, whether that ultimately was the right position for their shareholders and to create this sort of shareholder value over the next few years. And whether that ultimately succeeds isn't really the point. The point that I'm trying to make is that they weren't emotionally attached to the original strategy. They were willing to adapt in the best interest of shareholders. To me, that's really what good boards do. They don't get emotionally wrapped around one strategy. They have to be flexible enough to pivot if something currently isn't working.
Okay, so that's what you mean by a mini SPAC?
Yeah, for the most part, not because they became a SPAC, but because they started thinking differently about the public company that they already had. They looked at the listing, the capital, and the market and asked the question, what's the best way to create shareholder value? That's the framework I'm talking about that's sort of similar to the SPAC model, just without all the legal burdens and regulatory, bureaucracy.
So if you walked into one of those board meetings tomorrow morning, what would be the first question that you'd ask?
Well, frankly, Caroline, and I'm sure this is where some people listening are going to disagree with me, but I would really start with one simple question. If the digital asset prices stayed exactly where they are today for the next 3 years, what would be our plan? I think that really is the question every board right now has to ask themselves, because that's when you really find out whether you're, executing a strategy to build long-term shareholder value, or you're just simply hoping that the market comes back and there's not a lot for you to do.
Yeah, that's definitely a tough question.
Well, it is. And I think because it forces everyone to stop assuming the market is going to bail them out. I mean, I would probably ask another question too, Caroline. I would say, why should someone own our stock instead of simply buying the underlying digital asset, if premiums are really no longer there? If management or the boards can't answer that question, then they have a lot of work to do.
Is there anything else?
Well, look, I think that's a good start. Maybe I'd ask one more question, but those first two questions I think are sort of really, really important. But maybe the next question would be something like, what does the future look like? What do you want your second chapter to look like? If the first chapter was raising the digital assets and putting them on your balance sheet, then what does the second chapter look like? Is it a combination of digital assets and maybe an acquisition, pivoting to a new business line? Maybe some of these companies are going to go back to the legacy business. I mean, who knows? But I think these are all the questions that separate the good boards from everyone else. And they don't spend all their time trying to, hope for tomorrow or recreate yesterday. They're really thinking about tomorrow and trying to find the solutions to add to this shareholder value over the next few years.
So you've spent your career sitting in boardrooms with founders, public companies, and boards of directors. Are those conversations actually changing?
Absolutely. I've been, sitting in boardrooms for the better part of 20 years. And one thing I've learned is that the questions always change as the markets change, at least for the good boards. A year ago, everyone wanted to know which digital asset they should own. Today, the better boards are starting to have conversations and asking different questions. They're asking, how do we use this public company to create durable shareholder value into the future? And that's a much better question. The problem is, I still don't believe enough boards are having these conversations internally. The good ones certainly are, and the other ones really have to start having these conversations.
So is that what separates the better boards?
I mean, I think so. Good boards, look, don't fall in love with the strategy. They're not, wed to the past. They fall in love with creating shareholder value. If the facts change, they have to be willing to change. Caroline, it's interesting because I actually think a lot. I think about this question a lot, at our own firm and sort of in my own career. And the one thing I've learned over the last 20 years is that falling in love with the transaction or the structure is never really a good idea. For me, it's more about falling in love with helping the client achieve the objective because, sometimes it's an IPO, sometimes it's a reverse merger, sometimes, I'm telling a client, hey, don't do anything at all. It's too early or not the right time. So if you're focused on the objective instead of and the result, instead of being attached to something from the past or just having a closed mindset, you're most likely to find the right direction and ultimately make the right decision. And I think the best boards operate the same way. They don't become emotionally attached to a particular strategy or to the past. They're really, committed, I would say, to creating long-term shareholder value. And that's where the good boards will adapt if the situation, presents itself.
So it sounds like this really isn't about digital assets anymore, is it?
Well, it's still about digital assets to some degree. There's a reason we're having this conversation in the first place, but eventually every public company gets judged the same way. Can management and the board create the right type of long-term shareholder value? Digital assets may be a part of that answer, but in my view, that usually isn't the entire answer. Save a few exceptions like maybe BitMine.
So your message, Joe, isn't that the Treasury strategy failed. It's that the strategy still has to evolve.
Exactly. I mean, we're still in the middle of the game here. I don't think the first chapter was a mistake. In many cases, it was incredibly successful. I mean, I think about this. The digital asset treasury deals that saved about, I would say, 200 public companies last year from being delisted or being in a really sort of bad spot. I mean, that alone is a wonderful thing. 200 companies are still on NASDAQ, still with good asset value. But now the question really becomes whether those management teams and boards recognize that there's an entirely different chapter about to be written. And the companies that create tremendous value over the next few years are the ones that are going to recognize they have to make a decision. What that decision is, nobody knows, but they cannot just rest on their laurels. They cannot just rest on the past. They cannot just hope for the market to come back. They have to really ask the tough questions, look into the future, and find out what is best for their company to be able to create long-term shareholder value.
And where do you think all of this goes from here?
Well, I think we're entering a period where the market starts separating companies with a credible second chapter from those who don't. And this really ties into the new NASDAQ rules that have been passed, especially this $5 million market cap rule. Last year, investors were primarily evaluating treasury strategies on which coin is the best or hottest. And over the next several years, I think we're going to spend a lot of time evaluating management teams and boards on what comes next, because once everyone has access to the same playbook, execution really becomes the differentiator. And it's not like, they're making these things up. I mean, they have to create value, and there's only so many ways you can do that. So unless there's another fad or another exciting theme that comes down, like the digital asset treasuries, it really becomes about execution. Execution of what? What is that next thing? And again, there's only a few options you can choose from, and acquisition or merger really seems like the likely candidate, at least in my view. Hence, again, the mini SPAC reference.
So can you tell us, Joe, from your perspective, what does a credible second chapter look like?
I don't think there's one answer, Caroline. For some companies, it may be continuing to build this digital asset treasury strategy. For others, it's making acquisitions that maybe complement the digital asset treasury strategy that they've built. Maybe they have half and half. And then for others, they may pursue real pivots or real reverse mergers or, full blown acquisitions into something new. And yes, some companies simply won't adapt and they're probably going to wilt away and get delisted. But every board has to evaluate those alternatives based on its own facts and circumstances.
All right, so let's switch perspectives for a minute. If you're an investor looking at one of these companies today, what are you paying attention to?
Well, in my view, the first thing I'm looking at, and probably, one of the only things is really management. And the question for me is, do I believe this management team can actually execute in a chapter two, whatever that may be? Does management have either a proven track record of executing, or are they really forward thinking in their perspective? Or are they just a bunch of lifestyle guys that are looking to run the clock and make a great salary and just kind of keep their head down, to sustain their lifestyle? I believe really that is the most important question to ask. And it has to begin and start with the guys and gals who are running these companies, the management team.
So it's less about the coin and more about the people.
Yeah, for sure. I think the next chapter is all about the people, but I'm also looking at the capital. How much flexibility do they have? Not just your digital assets, but do they actually have cash on the balance sheet? Is it a mix of cash and coin, or is it all coin and it's very much undervalued, very much depressed? And you're not going to get a lot of cash value out of that to go put into another business. So it starts with management, but I think the amount of capital is a very important indicator as well.
Okay, so is there anything else?
I think those first two questions are pretty good. And, that's really what I'm focused on. But I guess the next thing would be, does the board really have the experience to evaluate strategic alternatives? Or are they sort of just along for the ride, like some of the board members that we've all kind of run across? Can they recognize a real opportunity? Can they make a decision? Similar criteria to management, can they execute? Or are they just kind of hoping and waiting for the market to return, and maybe we'll see another 18 months go by and nothing happens? So hope really isn't a business strategy. So I think if management lines up with a good mindset and the capital is there, it really then comes down to the board to be able to say, hey, let's go execute this thing and make something really big happen for our shareholders.
So let's just rewind for a minute. Earlier, you mentioned acquisitions and reverse mergers. Why do you think we're going to see more of those?
Because many of these companies already possess something private companies spend years trying to obtain, right? They have a NASDAQ listing, they have a shareholder base, and a lot of them have lots of capital. So if a board concludes that simply holding, these assets, these digital treasuries are no longer the highest and best use of that platform, that vehicle, then acquisitions and strategic mergers and reverse mergers become the next logical alternative, I think, to evaluate, because not because they're trendy, but because they may be able to create the most long-term shareholder value for those vehicles.
So are you saying that reverse mergers are back?
Well, I don't know that they ever went away, so I'm not so sure they're back. They're certainly active, and I don't think, reverse mergers are ever going to replace the traditional IPO, although if you look at 2026 data, they may be pretty close. Certainly, if you include all of the alternative pathways like direct listings and uplistings, they certainly outpace the traditional IPO. This has really never happened before in recorded history, where the alternatives are outpacing the traditional IPO. But again, are reverse mergers back? Yes, I think they're back, and they're going to be popular to some degree because of all of these companies who are sitting on the cash and the coin and have a real need to do something over the next 6 to 12 months instead of just sitting around and waiting for the market to change.
So this seems like a viable strategy.
Absolutely. When it's done correctly, though, I do want to point that out. It has to be done correctly. There's rules to follow. It has to be done with a quality company. There has to be proper due diligence, and really you have to have the right advisors, Caroline. I can't overemphasize enough the importance of the quality of the advisors that you surround yourself with, because it is the most important part, I think, of getting a deal done right now. And you have to sort of have advisors that come from within the system in a lot of ways. They know the system, they understand the playbook, because the emerging growth markets has substantially changed over the last year. And those who are still operating, and I see it all the time, with an old playbook or a mindset from last year, they are never going to get their clients over the finish line. And one more thing that you need, and I say this all the time, is you also need the right structure, because no advisor, right, is that much of a magician that with the wrong structure, that the exchanges just aren't going to approve. So you really have to have, I think, the willingness to want to do the transaction, the right advisors to execute that transaction, and then the right structure to be able to get the approval of the exchanges who you need to kind of really start that chapter 2 for these companies.
So bottom line, Joe, what's the one thing that you want people to take away from today's discussion?
Well, I leave everybody with something that goes like this. I think too many people are still looking at these companies through the lens of digital assets and hoping that things are going to change. To me, that's really yesterday's conversation. Tomorrow's conversation is what I really want to talk about, and that is what management and the boards need to do in order to build their platform, build their public vehicle, to what comes next for those shareholders. The Treasury strategy created the opportunity, but now the leadership of management and the leadership of the board is what's going to turn that initial opportunity into long-term shareholder value in Chapter 2.
So the real story isn't whether digital asset treasury companies succeeded or failed, it's what they become next.
That's exactly right. That's the story. I mean, none of us have a crystal ball. I can't predict any of this is going to work or not. But what I can tell you where the market is going. The first chapter was building the asset treasury companies. And the second chapter is really deciding what to do with it. And some companies will continue to be very successful in the digital asset treasury world, and they will create a lot of shareholder value. But others will use that capital. They'll use their influence with management and the board and their platform to pivot and pursue acquisitions and hopefully create long-term value for all of their shareholders. Now, there's no one right answer, but I do think the market is going to reward those companies that adapt more than those companies that stand still, because at the end of the day, investors, they don't buy a public company because of what it did yesterday. They invest because of what management and the boards are capable of building and doing tomorrow.
You've been listening to Inside the Emerging Growth Markets with Joseph Lucosky. For more insights from the trenches of the emerging growth markets, follow Joseph Lucosky on LinkedIn or subscribe to him on Substack. And if you found this episode helpful, please share it with someone in the market. And remember, if you have any questions, please send them to us at questions@lucbro.com. That's questions@lucbro.com. Thank you for listening, and we look forward to next time.